Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 43 in our series for 2021, and today's date is Friday, November the 26th. First, I'll be talking to Jason Eisner, a co-founder of BrandQuest, a strategy, culture and brand mentoring company, and he'll talk about whether businesses can run discounts in a difficult economy. And I'll be talking to Indeed economist Callum Pickering about the latest wages and jobs figures. But now let's talk to Jason Eisner.
Jason, tell us, how do people discount during an economic downturn? What are the rules?
What are the rules? Well, I don't think there are many rules. I think that's the most important thing. I think people during an economic downturn kind of just get scared. And I think, especially in Australia, one of our first things that we do is we just go straight to discounting.
Which, of course, affects your profits.
Well, it affects a whole lot of things. And so it's kind of a last resort type thing to do. And one of the things that it really does is it basically destroys your brand. Now, it depends on how much you've built up your brand and so forth, but it's not a great way. It's a very quick fix to an ongoing problem that if you were to just, it's probably the last resort to turn to, and people turn to use it as their first resort.
What are the rules? I mean, why is price important?
Well, that's a really good point. What is price? Well, price, I mean, if you think about it, price from an economics point of view is kind of everything that your business is about. It has both demand and supply involved in it. And so one of the things that you do there is that if you, certainly from I've come from a branding and marketing perspective, you can sum up everything that we do in price, because price has both the demand and the supply. So, and in demand is everything to do with what your product is worth and how much people like it and all these sort of things. And so that's often why price is really important. And it's also, by the way, the easiest thing that you can turn to. It's the quickest fix that you can do. So if you want to do something and see immediate return, change the price. And it's something that gets used, in my opinion, way too often. There are rules around it, as you pointed out to it, but it just gets used way too quickly and way too often, and probably a very short-term viewpoint when in reality, if you had a bit of thinking about it, it mightn't be the best way to go. So does that answer that question? But in terms of rules, there are a few rules to think about. There are sometimes when price, it is worthwhile discounting, and then there are sometimes when we would recommend against it.
So when is it worth discounting?
Well, it depends. Look, if your brand is a discount brand, if you're a low-cost brand and your brand is always a discounted brand, and really the reason why people come to you is because it's a discount, then there's probably a reason to discount it at every point in time. That's certainly thing. Another time when you might want to discount is when you have lots of product and you do want to get rid of it, that you have an oversupply. There is a reason to discount at that point in our viewpoint. And there might be a reason to do that. So even great brands like Apple on Black Friday will discount their product, but that's probably the only time a great brand like that would discount. There might be a reason that you're entering in a new market and you want to get some customers, early, if you're a new entrant into a market, there might be a reason to discount. And finally, if you're in a very competitive market with a very similar product and everybody else goes on discount, then there also might be a reason to discount.
Well, then you're getting into price wars.
And in Australia, it seems to be a thing that's what we've done. We've almost conditioned all of our consumers that it's a race to the bottom. So the way to think about this is, if you have a brand at all and you put money into your brand, if you have a brand and you put lots of money into it and you built it over time, discounting is kind of eroding that. It basically says the value of my brand is actually not as much as what I priced it at. I'm going to discount it, and your value goes. And I'm saying, you shouldn't need to pay full price for my brand. It's not worth it. And the best brands in the world don't.
So what you're saying is if you're setting a price, it has to be in conjunction with a marketing strategy.
Oh, absolutely. And what happens is a strategy, as you're saying, is about thinking about the long term, and price is a very short-term mechanism that you can change over time. And so what happens is it's the way that price normally works is everybody starts to get scared and they use a short-term lever like price. And then the reality is it actually affects their long-term strategy.
You mentioned Apple, and they hardly ever discount because they have a brand and a marketing strategy.
They'll never discount. And, so when we say never discount, if you are a business customer, you might be able to get 3 or 4%. If you're a student, you might be able to get or school education, you might be able to get a discount. But it's very minor. It's not, it would never be more than 10%, I would, at the most. And they're able to control their price, and they actually have a price premium. So it's not even that they discount. Is if you take a similar product, a phone, a computer, they're normally a considerable amount more than the competitive product. Samsung phone to an Apple phone, the Apple phone is more expensive. And so they actually use price in the opposite way to actually it actually builds into their brand, their price, that this is a quality product and so forth. So it can actually go the other way. Price actually sets expectations of where you get placed in the market and so forth.
Other examples of that would be cars like Mercedes-Benz, BMWs, Audis. They don't discount as opposed to, say, a Kia or a Suzuki.
Yeah, look, they do. At the end of the year, they might discount by offering off not paying, the car tax, luxury car tax, or they might not charge GST, but it's very, very small compared to to more discounted brands. However, having said that, the difference between some of those brands is that they have franchisees and they get control of the price. So in general, the brands, the big luxury brands, tend not to discount because they realize that if you put lots and lots of money into building your brand, all you're doing is destroying that brand value if you discount too much.
How do you determine if I'm a business? How do I determine whether I should discount?
Well, we've developed a little framework here, but effectively, the way we look at it is this way. And I'm going to try and draw this in a podcast. But if you think about an axis of price versus quality service, so let's call it the y-axis. The vertical axis is price, and that goes from low to high. And the x-axis, the horizontal axis, is quality service, and that goes from low to high. If you were to break that up into a quadrant, what you would have is that if you're reading from the top right quadrant, you would have prestige right up the top high price, high quality. And in the bottom left quadrant, you would have budget commodity. That's a low price, low quality. The other two are interesting. If you have a low quality or service and high price, that's kind of a monopoly, uncompetitive situation, which not too many people exist in there. But if you were a monopoly, certainly, if you think back to what was 20 years ago or 30 years ago when we had monopolies like telecom and those sort of things, you could put them in there. And the other quadrant is the bottom right quadrant, which is which is where you have basically high quality service and not as high price, like it's a lower price. You have these 4 quadrants. So, and that's the value, almost mastige market. And so the way to think about this is if I am in the top right prestige premium market, you're pretty hard pressed to discount. Wouldn't be thinking about doing that at all, because you've actually got a high value product, high service, it costs a lot. Why would you discount? Similarly, if I was in the budget commodity market with low price, low quality, then I think I would be, that's kind of where you are in this discount thing, and it's a race to the bottom. But, sometimes there are brands in there that are always low price, and that's what they sell on. I mean, the way to think about that maybe is Audi, where they have low prices. Their actual economic model is a low price. That they probably have quite good quality, but the way they're selling on is this low price model. You then have these other two quadrants. The monopoly one, if you're in the top right of this thing where you're high priced and low service, then it probably doesn't make sense to discount. And finally, the one that's of interest is the one where you are high quality service, but you actually at a lower price point, which is, you have to think about these brands where they've changed the economic model. There you might well be able to discount because you're adding, your price point, the way you get to the market is much, your business model is completely different to what exists in the marketplace. And there you might think about discounting.
Well, in that case, that would require each business in this market to actually look at what their business model is and work out where they sit in that market. And that requires some very hard questions.
It does. And I think the point is, I think what it says to you is, by sitting down and thinking about it, it means that you're not actually going straight to the lever, I'm just going to discount the price. Yeah. And that's kind of what you think you see. I mean, you think about it, the department stores do this all the time. They are always on sale, and they're taking quality brands and discounting them. Now, even as a brand manufacturer, somebody going into that, like I would be, that's also a problem because you're actually discounting my value. Like I set a certain price and you're cutting it all the time. But as the organization, like the department store, you're constantly using price to bring people in. And then people get conditioned, margins go down, the whole business model starts to unwind.
Which is why department stores are in major trouble at the moment.
Yeah.
And that's going to be fascinating to watch. And Jason, thank you very much for your time.
No, thank you.
And now let's talk to Indeed economist Callum Pickering.
What do you make of the latest jobs figures and the wages figures?
Well, there was a lot to take out of the data that came out last week and this week. The jobs figures were pretty weak overall. They're obviously still impacted by those lockdowns in New South Wales and Victoria. Employment fell by 46,000 people. It's down by 334,000 people since July. So that's a decline of 2.5%. So obviously from that perspective, the jobs market has been pretty weak. Of course, now with both New South Wales and Victoria opening up, it is likely that workers are going to flood back into the labour market. Employment is going to spike quite sharply, as it has done in previous lockdowns. And we'll get those employment figures back to where we were before those extended lockdowns began. The wage data was also interesting. So up 0.6% in the September quarter, which is a reasonably good result. Overall wages are up 2.2% over the year, which is back to where we were before the pandemic began. I think the big number, though, is the private sector wages are up 2.4% over the past year, and that's actually the strongest annual result since December 2014. So we're making some progress on that front.
Okay, but we're still a long way off from getting anywhere near 3% in wages, aren't we?
Yeah, that's right. I mean, it's small steps, but it is a step in the right direction. We haven't hit 3% wage growth in about 8 years. And it's still going to take a little bit more time before we can achieve that. Now, there's cause to be optimistic. There's, job creation is very strong right now. There's high level of job vacancies, strong number of job advertisements. And normally that means that employment is going to pick up, that the unemployment rate is going to go down. And that should feed into greater wage pressures. But so far, wages are reasonably low across most industries. There's only one industry at the moment that has wage growth above 3%. That's professional services at 3.4%. There's a couple of other industries such as construction, accommodation and food services that are in the 2.5% range. So they're heading in the right direction. But then there's a range of industries where wage growth is still below 2%. So while these skill shortages are emerging, while there is some difficulty filling some roles, it hasn't been sufficient to cause wage growth to pick up to where we need it to be, which is above that 3% threshold.
Well, what was interesting with the wages figures, I was looking at some of the data on individual agreements, and there was a significant portion, something like more than 30%, had been waiting more than close to 2 years to get any wage rise.
Yeah, that's right. Wage freezes were a common occurrence throughout the first year of the pandemic, and slowly we're seeing a bit of catch-up on the wage front, particularly with the agreements that are being made, both individual, enterprise and awards. So that is a good sign. But the individual enterprise agreements and the way the system works does mean that there is going to be a bit of a delay between what's happening with labour market conditions, which in general appear as though they are going to improve, that the labour market's going to get tighter, and that actually feeding through to stronger wage growth. These agreements aren't updated regularly. For the most part, they're usually updated once a year or thereabouts, which means that there could be a little bit of a delay between us getting a very low unemployment rate. And I think there's a chance we're maybe in that low 4% range early next year, and that flowing through into greater wage pressures.
Right, but it would all indicate that the pandemic has actually caused a lot of difficulty with people's living standards.
Well, that's absolutely right. Yeah, wage growth was very low throughout the first year of the pandemic. It's obviously gradually improving now. But yeah, a lot of workers were dealing with wage freezes during a very difficult period for households. So it's good to see that that's beginning to change, but there's obviously still a long way to go yet.
The unemployment actually went up to, 5.2%? That was because more people were coming back into the workforce, so there weren't enough jobs to be filled? What's the explanation of that?
Yeah, we saw a bit of a tick up in participation during October, and that was because, it was largely in anticipation of Sydney opening up, easing their restrictions. So employment in New South Wales bounced back a little bit in October after falling considerably over the previous 3 months. So that's really what was happening there. People flooding back into the workforce because they could, because the economy was beginning to reopen. So that wasn't necessarily a bad sign, particularly when you consider that the unemployment rate is consistently understated for states that are in lockdown. We've seen that with New South Wales and Victoria recently, where the unemployment rate at 5.4%, 5.6% in both those states is actually reasonably low. And yet there's a lot of people out of work, and participation is quite low as well. So as these lockdowns get lifted, one of the consequences of that is that people flood back into the workforce, and the unemployment rate in both New South Wales and Victoria might actually increase a little bit in the near term. Even though more people are finding jobs. So it's a bit of a weird dynamic there, but I don't think it's too much to be concerned about, because we are going to see hundreds of thousands of people across both states re-enter the workforce over the next 2 to 3 months, and that will cause the unemployment rate to get back to roughly where it was before those lockdowns began. And that's going to bring down the national average as well.
So you can see it going down closer to 4%.
Look, I think over the next 6 months, certainly over the next 12 months, we are going to see an unemployment rate in that low 4% range. The level of job creation across the country right now is as high as we've ever seen. It's particularly strong in both New South Wales and Victoria, which is a key indicator that both states, from an economic perspective, are going to rebound strongly now that they're opening up. And I think all signs point to a further tightening in the labour market. I think we can be pretty optimistic about what's happening in that space and what it means for jobs going forward. So, yeah, don't be surprised if we're seeing an unemployment rate in that low 4% range, which is something we haven't seen since the global financial crisis began all the way back in 2008.
So, but there's an issue too about closed borders, and a lot of businesses are saying they've got a skill shortage as well.
Yeah, anecdotally, a lot of the businesses I talk to talk a lot about it being difficult to find suitable staff for some roles, in particular finding enough candidates. Sometimes they'll only be able to find 1 or 2 okay candidates, but they're not getting as many people as they were before the pandemic began. And that's contributing to the calls to open the borders and to increase the level of immigration across the country. And to some degree that makes sense, because Australia's population has barely grown over the past year. It's increased by just 0.1%. Which compares to a 1.5% annual increase in population before the pandemic began. It's particularly problematic in places such as Victoria, where population growth before the pandemic was 2%. Now it's actually contracted by about 0.6% over the past year. So that's creating a really difficult dynamic for recruiters, which is one of the reasons why skill shortages do appear to be emerging. That said, those skill shortages haven't yet contributed to a material increase in wage growth. So businesses, while they are struggling to fill some roles, they don't appear to be willing to increase what they're offering in terms of pay or benefits or conditions.
Do you expect the skill shortages will, in time, contribute to wage growth?
Well, the longer these skill shortages persist, the more likely it is that businesses will need to address that. And they'll address that through increasing compensation and other benefits. The skill shortages that we're dealing with at the moment have sort of lasted for basically the last 12 months or so, following the reopening of the economies last year. I think as we push into year 2 of that, the pressure on recruiters and businesses to fill some of these roles will get greater, and businesses will begin to pass on higher wages in order to attract better talent.
Now, the $64 question is, where does that leave the RBA? The RBA is insisting they're going to stick to their 2024 deadline before raising rates, but there's a school of economists who are saying, no, it could be as next year.
Yeah, there's a bit of a divergence between the RBA and other economists right now. I think the RBA is playing it very cautious, and I think one of the reasons for that is because they've been burned in the past by being too optimistic about wage growth. They consistently overestimated wage growth in that post-2014 period, often to a very large degree, and so I think they're a little bit gun-shy at the moment. They're playing a little bit cautious so that they don't make that mistake again. So I think there is a little bit of upside to wage growth due to the strong job creation that we're seeing. But we do know, and the Reserve Bank has done a lot of research on this, that it takes a longer time now for those changes in labour market conditions to translate into higher wages. And that's because of the individual and enterprise agreements that are in place. So that flow through of a tight labour market does take a little bit longer than it has in the past. So that's one thing to bear in mind. But I do think overall there is a fair bit of upside risk to the RBA's forecasts on unemployment, as well as inflation, and that could certainly trigger a rate rise before that 2024 deadline. I think the Reserve Bank will be a little bit cautious. They don't want to pull the trigger next year, but certainly if conditions warranted it, if wage growth was above 3%, I think they would certainly change their tune pretty quickly.
Well, Callum, thank you very much for your time.
And thank you, Leon.
So what's happening in the news? Well, President Joe Biden nominated Jerome Powell for a second 4-year term as US Federal Reserve Chairman and elevated Governor Lael Brainard to Vice Chair in a politically expedient move that also maintains continuity at the central bank as it deals with a 31-year high in inflation. In announcing the nominations on Monday, President Biden said both Mr. Powell and Dr. Brainard had helped achieve a successful economic recovery from the pandemic and that he was confident they would control inflation. Powell will confront significant challenges as he embarks on 4 more years as America's top monetary policymaker, chiefly how to manage an economy that is not back to full employment at a time of uncomfortably high inflation. Powell will also be under pressure from progressives to understand and address the economic and financial market implications of uncontrolled wildfires, super powerful hurricanes, and other devastating impacts of climate change. Fed officials have also become more outspoken on racial and gender inequities to drag on economic growth. And a COVID-19 spike across Europe and the US has hit the equity market and threatens to stunt the global economic recovery, despite vaccines, treatments, and a willingness among consumers and businesses to adapt to pandemic restrictions. The lockdown imposed in Austria beginning this week has pressured neighbouring Germany to consider similar measures, while case numbers have begun to climb across the continent, sapping European shares and pushing back rate hike expectations for the European Central Bank. In the US, a surge in new infections has again caused angst over the potential hit to economic growth and has depressed share prices in a plunge that extended to Australia on Monday. The S&P ASX 200 fell 0.6% as travel stocks and businesses with broad exposure to European and American markets fell, including travel agents and airlines. Declines for Flight Centre, Corporate Travel Management and Qantas have been among the top losses, reflecting a rethink of previously bullish sentiment after the Delta COVID-19 wave earlier in the year. And business owners are being told they should set their own rules on whether customers and staff have to be vaccinated in a message from Prime Minister Scott Morrison that takes on state premiers amid uproar in federal parliament over vaccine mandates. With some of his own Liberal colleagues moving against the government on vaccine rules, Mr Morrison tried to quell a damaging dispute in Parliament by insisting he would not enforce employers to demand vaccinations for their workers and customers. The claim puts the Prime Minister at odds once more with state health orders that ask retailers, event organisers and others to ask for proof of vaccination, as the issue sparks public protests and fury from Conservatives, including Pauline Hanson's One Nation. The government was thrown on the defensive on Monday when Senator Hanson sought to pass a private bill in the upper house to overturn the health orders, gaining support from 5 Liberals and Nationals who crossed the floor to defy Mr Morrison. The One Nation bill was backed by Liberal Senators Conchetta Fierravanti-Wells, Gerard Rennick and Alex Antic, as well as National Senator Matt Canavan and Sam McMahon, in a sign of the deep grievances over state rules that impose greater restrictions on those who are not vaccinated. Senator Hanson and a colleague Malcolm Roberts were participating online and could not vote, while Liberal Senator Eric Abetz abstained rather than siding with the government in the majority vote to block the bill. Tasmanian Independent Jackie Lambie angrily denounced the One Nation move and argued for controls that allowed more liberty for who signed up for the vaccine, saying people had to think of others. And Deputy Prime Minister Barnaby Joyce is poised to appoint a former regional mayor from his New South Wales electorate of New England as chairman of the federal government's Independent Infrastructure Advisory Panel on a 6-figure salary. The opposition used federal parliament on Tuesday to attack Mr Joyce's links to Col Murray, who retired after 11 years as mayor and 4 terms on the Tamworth Regional Council earlier this month, accusing Mr Joyce of showing contempt for impartial infrastructure advice. He's expected to be announced as his chairman of Infrastructure Australia, an independent statutory body that provides research and advice to all levels of government and industry on projects and reforms relating to investment in infrastructure on Thursday. The body's latest list of priority projects announced earlier this year had a combined value of at least $59 billion. Mr Murray, who told magazine The Monthly last year that he was a fairly solid Barnaby supporter, has a history in the construction industry and has chaired several regional and local government lobby groups during his career in local government. He's also on the board of the University of New England. Labor's infrastructure spokeswoman Catherine King criticised Mr Murray's appointment during question time, contrasting him with the first chair of the body, former British Airways CEO and News Corps director Sir Rod Eddington. She said her side of politics had established Infrastructure Australia to provide impartial advice to governments and industry across the country. And the federal government has ignored the pleas of technology industry bodies and passed a bill that will enable it to take control of private infrastructure as a last resort in the event of a cyber attack. The Security Legislation Amendment Critical Infrastructure Bill 2020 was passed by the Senate on Monday night, with both the major parties backing it. The Greens dissented, terming the bill a greedy little power grab, which did not have the backing of key stakeholders. And missing Sydney businesswoman Melissa Caddick's assets could soon be sold to repay more than $23 million she stole from her friends and clients. Ms Caddick is suspected of stealing millions before she vanished from a Dover Heights home just over a year ago. In a major win for her victims, some of Ms Caddick's assets will be sold, but not all of the money she took will be returned. The $6 million Dover Heights mansion is among Ms Caddick's assets to be carved up after the federal court officially appointed receivers and liquidators. Anthony Coletti, Ms Caddick's husband, now stands to lose his home. The property sale will only be a fraction of what Ms Caddick owed to 72 clients, who she stole more than $23 million from over 8 years. Ms Caddick spent the money on designer cars, clothing, jewellery and overseas trips instead of investing it. She vanished a day after ASIC raids last November. Some of her remains later washed up on a south coast beach. And Australia's red-hot property market has started to cool, with prices to peak next year and sink 10% in 2023 as higher borrowing costs and natural fatigue set in, the nation's largest mortgage lender predicts. Home prices in Sydney, which will post among the fastest gain in 2021 with a forecast 27% jump, will moderate to a 6% advance in 2022, according to Gareth Aird, head of Australian economics for the Commonwealth Bank. By 2023, though, the harbour city's prices will fall 12%, the equal most of any capital city, matching Hobart's predicted retreat. Melbourne, which was harder hit by the pandemic-related lockdowns, will post a 17% rise in property prices in 2021, among the smallest gains. Price pressures will persist a bit longer, with the CBA tipping an 8% advance in prices next year before a 10% decline in 2023. Aird forecasts the Reserve Bank of Australia will begin a gradual and shallow cycle from next year, taking the official cash rate from its current record of 0.1% to 1.25% by the third quarter of 2023. And Australia will face a rental affordability crisis as domestic and international borders reopen, with Brisbane hardest hit as insufficient new supply pushes rents up more than 5% a year over the next 5 years. The opening up of domestic borders to interstate travel, national borders to international travel, and the likely return of immigrants and foreign students will put pressure on all of Australia's cities, commercial real estate agency JLL's Q3 2021 apartment market overview shows. But the 7% decline in the national inner-city apartment pipeline in the September quarter from just 3 months earlier, the latest piece in a picture of decline that has been underway for 4 years, makes clear the significance of the worsening supply situation as borders reopen. The latest quarterly report shows that the apartment pipeline to 2025 of apartments complete so far this year under construction in marketing with plans approved or submitted for approval fell to 62,655 across the mainland capital cities from 67,154 in the June quarter. And the Commonwealth Bank fired a newly recruited employee in part because he discussed his pay with colleagues in breach of the company's controversial salary secrecy clauses, contradicting assurances from the chief, Matt Coman, that the prohibition is not enforced. The Finance Sector Union has launched legal action against the bank over the sacking of the home loan consultant in one of the first challenges related to pay secrecy. The union argues the sacking offended workers' rights to make a workplace complaint or inquiry, in this case the lender's concerned that the bank was underpaying him or his colleagues. It comes as Labor has promised to outlaw the clauses for all companies if it wins the federal election next year. FSU National Secretary Angela Angrisano said CBA included the prohibition in every contract, and members reported that managers are regularly hosing down conversations and reminding people that pay is confidential. And one of Virgin Australia's staff has resigned because of complaints about her behaviour. Virgin Australia's Chief of Corporate Affairs has quit less than a year into the role amid an internal review of her workplace behaviour. CEO Joan Herdlicker announced the resignation of Moksha Watts to staff on Sunday in an internal memo. Ms Herdlicker noted Ms Watts had taken the decision in the midst of an ongoing internal review about her workplace behaviour. Ms Watts was one of 6 appointments to Virgin's executive leadership team soon after the sale of the airline to US private equity firm Bain Capital. She joined Virgin Australia after a 7-month stint with the Arnott's Group and previously spent 4 years with Qantas and Jetstar, where she got to know Ms Herdlicker, a former Jetstar CEO. The University of Sydney Arts and Science graduate also worked as an advisor to former Labor Prime Minister Kevin Rudd in 2013, following stints with Anthony Albanese and Jenny Macklin. Ms Watts' resignation from Virgin came after a significant turnover of staff in the Corporate Affairs Department. The difficult working environment was flagged with Human Resources as far back as April, and employees have continually requested mental health or stress leave to cope with incidents described by these sources, including meetings where it was alleged Ms Watts would openly and aggressively criticise and belittle staffers. And in a year when the scandal-plagued casino industry, damaged by 3 royal commissions into Crown Resorts, has been forced to clean up its act, poker machine manufacturer Aristocrat Leisure took the task literally. As the pandemic shut casinos and dented Aristocrat's turnover, the $30 billion ASX company filed a patent in the United States for self-disinfecting poker machines. Aristocrat Technology said it could make poker machines or retrofit them with ultraviolet light to rid high-touch surfaces and buttons of COVID-19 and other pathogens. The UV light, which a company insists can be deployed safely by limiting exposure to UV radiation that might cause skin damage or retinal damage, could be activated on demand during idle times or during off hours for a more thorough disinfection with a higher intensity UV light. And Woodside will press ahead with the biggest oil and gas development to be built in Australia in a decade after sanctioning its $16.5 billion Scarborough project off Western Australia. In a move that has enraged green groups, Woodside announced that it had approved the Scarborough development and the associated upgrade of its Pluto liquefied natural gas facility near Karratha, 1,600 kilometres north of Perth. A report by 2 groups, the Conservation Council of Western Australia and the Australian Institute, suggested the development could lead to lifetime emissions equivalent to that released by 15 coal-fired power stations. The investment decision is the first major fossil fuel project to be announced since the global climate talks in Glasgow, which urged nations to rapidly cut greenhouse gas emissions. A coalition of environmental organisations opposing Woodside Petroleum's go-ahead for the $16.5 billion Scarborough LNG mega deal in Western Australia have vowed to step up pressure on the oil and gas giant's investors and financiers. The decision comes despite a furious last-minute ditch by environmentalists to stymie the project after the Conservation Council of Australia last week launched legal action, claiming the project required assessment under federal law. The decision also coincided with news that the boards of Woodside and BHP had agreed to merge their petroleum businesses in a $40 billion deal, which will create one of the world's biggest fossil fuel players. With a price tag of $16.5 billion, Scarborough is set to be the world's biggest oil and gas development undertaken in Australia since the end of a $275 billion investment splurge 10 years ago. The The project will involve the construction of a 430-kilometre pipeline linking the Scarborough gas field to the mainland, as well as a second production train at the Pluto LNG processing plant. At the peak of construction, as many as 3,200 jobs are expected to be created, with a first production slated for 2026. And biotech giant CSL is on the hunt for startups to move into its new Melbourne headquarters as it launches an incubator program designed to commercialise Australian ideas and keep research onshore. The $444.5 billion coronavirus vaccine maker has inked a deal with the University of Melbourne and Walter and Eliza Hall Institute to launch a $95 million incubator project, which will also be supported by the Victorian Government's Breakthrough Victoria Fund. The incubator, which is set to launch in 2023, will have space for up to 40 Australian companies that are looking to move their early-stage research towards commercialisation. The companies will be based at CSL's new global headquarters on Melbourne's Elizabeth Street and have access to office space, equipment and lab facilities. The collaboration comes as the country focuses on manufacturing its own medical products, including vaccines, following the COVID-19 pandemic. CSL Chief Executive Paul Perreault said the program was also designed to help researchers learn how to bring new products to market. And corporate regulator Joe Longo has urged consumers to show a high degree of caution towards the cryptocurrency craze, urging people to be careful about putting their savings into an unregulated asset class that many do not fully understand, and admitting the regulator is virtually powerless to intervene and consumers are on their own. Mr Longo, Chair of the Australian Securities Investments Commission, or ASIC, on Monday said the phenomenal cryptocurrency boom had become too big to ignore, but consumers should be aware of the risks before plunging into crypto. Following last week's Reserve Bank warning about the risk of crypto assets plunging, Mr Longo on Monday said it was not ASIC's job to stop people investing in cryptocurrencies, but they should be aware of the risk. He said there had been extraordinary demand for crypto assets from investors and consumers, fuelled by ultra-low interest rates and the pandemic, and warned that consumers were on their own, given the lack of any regulatory protections. And that's it for this week. And next week I'll be talking to Frontier Pets founder Diana Scott to discuss how Frontier Pets is helping put an end to the 500 million Australian animals stuck in factory farming, and how they've created the additional sources of income for Australian farmers. And I'll be talking to economist Saul Eslake about how Australia will manage the recovery. In the meantime, you can catch me on Facebook, Twitter and LinkedIn. And if you want, leave a comment. Wishing you all a safe and